Okay.
Justin, what are we doing today?
Josh, we've got some shipping news and some ZIM news to share.
Yeah,
Josh,
for
man,
those of you that don't know, I am nuts deep in this one company, ZIM, ZIM. It is by far my biggest trading size I've ever had on, and not in like similar to percent terms. I've done this once before last year. I would argue a few times a year, but I'd say one or two, maybe three times a year where you get an opportunity that is truly where you could double, triple your portfolio for a defined, pretty low risk. And I'm putting all my risk into options, and I know my risk, I know my reward, and I'm ready to see how it plays out. And I would like to buy more. Let's just take a look at the chart here. A few weeks ago, maybe a month or two, 3 months, we were talking about ZIM. I was buying a few calls around the $42 mark, and then instantly we just saw a pop to $60, and I was like, holy shit, I love the company, but this is just overran. And I was telling Justin, hey, I kind of want to go short this company. It's just ran way too far, way too fast. I think a pullback is highly likely, but I'm just gonna sell my position, and we'll hopefully get a better buying opportunity soon in the future. And we saw just that. We saw a run back down to around $44, where I started absolutely loading up on options. And we're going to show you why this is just a company that is making a lot of money, a lot of fucking money, which is pretty rare in the stock market that we are living in today. Maybe no one will ever care if a company makes money or not, but that's how I like to trade. So we're going to pull up the fundamentals. Do you have anything to say, Justin?
there's just to kind of add into that. So one of the other things to note about ZIM and probably all the other shippers, but I think ZIM's probably the one you can keep an eye on the most so far, is that when you have these logistics backup, think like Evergreen from earlier this year, the other Chinese crisis, where we got stuck in the Suez Canal. Point is that like, if you are a manufacturer trying to ship your goods from point A to point B, like you are going to pay whatever price the shippers, whether it's air, sea, whatever, are going to demand, because simply not selling your products is not going to be an option. Now, the consumer might have to eat that at the end of the day, but the point is that the producers need the shippers more than the shippers need the producers. So that bodes very well.
Exactly. And I would argue there's a lot of headlines coming out like last week or 2 weeks ago, because the chart of the shipping stocks from going from China to the US would drop by like 30 or 50%. And it was like, oh my God, it was just a massive supply chain issue. Now shipping rates are going to come right back down. Let's short all these companies. There's really no reason to be in them if shipping rates aren't at all-time highs. But what happened? Shipping rates just went right back up. And I would also say this was just flat out fake news. It was only China from the US that shipping rates went down. On the aggregate total for the week of that a few weeks ago, shipping rates were actually up on the week. And let's just say, like, the issue is not just that there's a lack of ships, which there is. There's also massive amounts of restrictions from the sickness that's going around. And an even bigger issue is actually the trucking issue. We can have as many ships as we want. They can come to the ports, they can unload the ports, and then they can leave. But if there's no trucks to take the actual cargo across the country, then all the ships will just be stuck there. They can't move if they don't unload, and they can't unload if they don't have trucks to unload the cargo. And there's no truckers. Yep. So what are you pulling up right now, Justin?
Yeah, Josh, and like I said, I assume you can see my screen. Let me know if you can't. But the other thing, too, to add into it, so just one other thing from the truckers, too, forget like the compensation aspect for a second. But if there are, let's say, restrictions from California that are being imposed upon the truckers, then you've got this problem, too. I mean, I'm fond of saying you can always tell who holds power in a relationship by seeing who holds the power to walk away. And at this particular point, much like, the producers need the shipping companies in order to move their goods and services, well, America, and probably the rest of the world, but just focusing on America for a second, we need the truckers to move the goods and services. Exactly. So the point is, truckers have a lot of power in this relationship. And if our good friends on the West Coast feel otherwise, perhaps maybe they can do something about it. But I'm pretty certain that you can't build an app to actually take a cargo container from a port in Long Beach and move it to Kentucky, just throwing it out there. Anyways, there was nothing, Josh, too. This kind of builds back into the shipping story. And this was a really good thread I came across a few days ago by Ryan Peterson. So I'll just go through it real quick. But the key thing on this front is that the backup in the ports is actually really being caused by the way that they're managing the empty containers. So the point is that, a truck goes to the port, picks up a container, takes the container to the destination, Walmart, whatever, right? It's unloaded. And then you've got an empty container that's got to go back to the port to go back to wherever, China, for example. The problem is that they had these restrictions in place that were preventing the empty containers, once they were unloaded at the destination, there's like the endpoint store, the distribution node to go on to, the endpoint, from being returned to the port. And this basically meant that if you had no trucks to take the full containers that were in the port because they couldn't drop off their already attached empty container, you've got a massive effing problem. So anyways, basically the takeaways from me from this article was that generally the bottleneck when it comes to the logistics of ports is actually the cranes. And that means to say, whatever you do, you want there to be no slack in the crane operations. That is, you always want the cranes, the big cranes that, take things off the ship. You always, always, always want those to be running. And in this particular case, they're basically just idling. And the reason they're idling, so you have this other backup from the containers, from the trucks not being available because they can't drop off the empty containers in the first place. Anyway. So the point is that there were some things I think that just happened this morning. There's a CNN article over here that was talking about it, where I think the administration pushed through a EO that basically fixed or will hopefully help fix the problem. But either way, returning to ZIM, the problem is that as long as there's a backup in the ports, there'll be a backup in shipping. As long as there's a backup in shipping, there will be a reduction in the supply of shipping. And if demand stays the same or increase, let's just say demand stays the same, what happens if the supply goes down and demand stays the same?
The prices go up.
Exactly.
Simple. So now let's actually look at what this company's doing and why this company in particular. All right. So here's what the actual fundamentals of the company look like. We're gonna kind of show Q2 of, this is gonna show 2021. Both there's on Q1 and Q2 on their balance sheet right now. They have $1.5 billion of cash or cash equivalents. What does that mean? They are a $5 billion market cap with $1.5 billion in cash. That is just an absolute ridiculous amount. And they already declared a dividend of approximately 30 to 50% of the Q1 net income in 2022. So let's think about this. If Q3 and Q4 we see another $1.5 billion in cash, which I think will be much more than that. That's going to be $3 billion of cash on their balance sheet with $5 billion market cap. If 50% of that could be a 20% dividend yield, just an absolute ridiculous amount. This company it spits cash. What is that? What is the risk of this company?
So I think the takeaway from that is that, of course, you'll have issues from time to time when ships are moored at sea. And well, it's true that one of the ZIM carriers was involved in an incident this past weekend. There was a fire, I think, off the coast of Vancouver. Number one, they're an Israeli company, so they probably have insurance against these kinds of things, and probably other things as well. So the point is that, of course, it sucks, but either way, the net of it is that from the ultimate perspective, they probably will be made whole to the extent. So I'm not too, like you, I'm not necessarily too worried about that. The other thing, Josh, just to add one other thing too, is that they've made 1.47 billion in profit. Or maybe actually put that, say it slightly differently. That is the free cash flow that they've generated for the first half.
That's just in 2021 too. I project, and many analysts project that Q3 and Q4, we're going to see much higher profits because rates have gone straight up. And ZIM is a company who rents their ships, but when it doesn't really matter what happens to the shipping index now, because the rates are locked in. You get a 2 to 3 year lease at current rates. So if ZIM positioned themselves well, got as many contracts as possible at all-time high shipping rates for the next 2 to 3 years, they're going to be in an incredible position to just ride the wave up. They also just bought a few carriers with just their cash because they have so much of it. They plan on buying a few more as well, which I don't think that's necessarily a bad idea. They're growing their business. I would project some share buybacks because we saw that with one of their biggest competitors, MATX. They just produced earnings, blew out earnings, and they're doing a buyback program. If ZIM was to be treated like MATX, who has a massive PE ratio of around like 3.4, which is just astronomical these days. And then ZIM would be approximately $150 a share, because right now ZIM has like a 1 to like 1.2 PE ratio. If they had like, it would be a tripling from here, which I don't even think that is too unrealistic to see a stock with a 3 PE ratio that is growing 300% a year. At least while shipping rates are at all-time highs, potentially given a 20% dividend yield, and when they could buy back like half of their entire company.
Josh, let me see if I can put some remedy or pare it down a little bit. Number one, the people who need to ship stuff will still need to ship stuff, and they will pay whatever they have to pay in order to ship stuff. Number two, there are structural supplies that are there are structural constraints that are there are structural constraints that are decreasing the supply available. You decrease the supply, you keep the demand the same or increase it, prices are going to go up. And the prices that go up will be paid regardless of whether or not the shippers, that is the people who need to use the shippers, like it or not, because they have to have their goods moved from point A to point B. And the last thing is ZIM did, I think, a $2 dividend back in May of this year. So basically that was, the first dividend that came through. If ZIM is making 700 million or so of free cash flow, not profit, but free cash flow per quarter for Q1 and Q2, and if in Q3 and Q4, you're going to see
1.5 billion, just to correct you.
Yeah, but let's just say worst case scenario. So let's just say you throttle back. Let's just say they're only making 700 million per quarter in Q1 and Q2. So that takes you to about your 1.4, 1.5 or so. But that's with the supply chain only being moderately screwed. Now, if the supply chain, that is with the port constraints, gets very screwed, well, guess what's going to happen? It's going to create a squeeze. And what's more, if ZIM's locked in their lease rates for their own vessels, they might not necessarily have to worry about their costs increasing until 2 or 3 years down the line. And at the same time, they can take advantage of the increase of rates because they know the shippers are going to pay the rates regardless of what the rates go to.
Exactly. So, and this is just my personal favorite company in the space. I think the space as a whole is going to perform extremely well. This was inevitable. We've been in a long-term 10-year bear market in the shipping industry, and the fundamentals on these companies were bound to go up no matter what. The catalysts with the government response to COVID has just amplified this 100-fold, which they did with many other sectors. This is just my favorite play right now. So Justin, till next time.
Take care, Josh.